Hello, I'm Jackie Abrams.
And I'm Barbara Grant Proctor.
And I'm with Sampson Properties.
And I'm with Cardinal Financial.
And we are back with mortgage financing and home buyer ready.
Wonderful.
It's been a little while since we have been on here. Last 2 weeks ago, I guess?
Mm-hmm. The
last show, we had a special guest, Steve Madewell.
Yes.
He was absolutely wonderful. Hopefully everyone saw Steve Madewell and heard him talk about home inspections and the importance of home inspections. Very, very important. So if you didn't get a chance to check out that show, please do so. And let me just, before we move on, let me say that if you are in the audience and you have any questions, homebuyingaudience@gmail.com to come to see our show. Mm-hmm. And if you have any questions, home buying questions, please email us and we will answer the questions while we're online. This week we are going to talk about down payment assistance programs, and we will be right back.
Hello, my name is Tania McQueen. I'm the Residential Services Manager for Prestige Community Resources. What our new facilities are respite centers. We're opening 2 in the city right now. Hopefully we'll expand to more. But respite centers are a place where people can come and get a little additional support with their mental health. Our one on Eastern Avenue is for men, and our one on Minnesota Avenue is for women. Our facilities are for all DC residents, especially focusing in on those in Ward 7 and 8. So they're really nice, and I'm excited for consumers to actually see them. What are the services that we're going to provide? Therapy, case management, medication management, all provided by professional staff, a licensed nurse practitioner, psychiatrists, sociologists, social workers, and then our paraprofessionals, our case managers. It's just a place where you can come and get the supports that you need to work on your personal goals, as well as to get your mental health straight. Simple, single adult, 18 years of age or older, a DC resident. You need to have insurance, but if you don't have it, it's okay. Still come, we'll work on getting you insurance. Have to have a negative COVID test, a negative TB test, and be willing to work on your mental health. For more information about respite services, you can contact us at 202-796-5000 or hit us up on our website at www.prestigecommunityresources.org.
And welcome back to Mortgage Financing and Home Buyer Ready. As Jackie told you earlier, our last show, it was awesome. We had Steve Madewell.
Yes.
Madewell. Don't you like that? Madewell.
He is a home inspector, and his real name is Madewell.
I love it. I love it. I love it. But he was here. He talked a lot about the home inspections and what we should look for. So now we want to move on with the process because we've given you guys a whole lot of stuff. So we want to continue to get to some more meat that you guys are ready for, right, Jackie?
Yes.
Today, we're going to talk about a few things. We're going to try to do this in 1 or 2 segments, but of course, if you have any questions, you know how to get us at homebuyingquestions@gmail.com. So we're going to talk today about the actual loan products.
Ooh, all right.
I know everybody wants to know what type of loan products are out there. So we're going to talk about the loan products, and then once we talk a little bit about the loan products, we're going to get into what everybody's been waiting for. The down payment assistance. How do I get money to help me close on my home? And you will be amazed at some of the things that we're about to tell you. We're going to give a little bit of tidbits and sneak little tidbits. Okay. We're going to sneak some little tidbits in there. And those of you that are watching and really listening to those tidbits that we're going to give you, not everybody knows about them. Right, Jackie?
That's right.
Not everybody knows about them, but we're going to give them to you, and we're going to tell you some way how you can get 100% financing.
Ooh, 100%.
100% financing.
Did you hear that? 100%.
When the last time was that around?
Ooh.
It was years ago. Was it before 2008?
Definitely.
It was definitely before 2008 that you could actually get 100% financing. Now it's with the loan program, and some of it you can use a down payment assistance, but we're going to talk about all of that. So let's get into some of the meat and potatoes right now. We're going to talk about a few loan products. The first one that we're going to talk about is the conventional loan. Conventional.
Okay.
And I think everyone knows what conventional loan is.
Well,
Everybody heard the term Fannie Mae,
Okay.
Freddie Mac. Everybody has heard those terms. Fannie Mae, Freddie Mac, right? That's what the conventional loan is, okay? Fannie and Freddie run the guidelines for conventional loans. Now, when you get a conventional loan, things are a little bit more stringent than some of the other loan products that I'm going to talk to you about. Like one, your debt to income ratios. Okay? Your ratios are a little bit tighter, which means you will own less home. Less home. And just to give an example, somebody with another loan product may be able to afford $400,000.
Okay.
That same person with conventional may only be able to afford like $350, $370.
Oh, it's that big of a difference.
Yeah, it's that big of a difference because it's the debt to income ratios. And what we mean by that is your income to the amount of money that you bring home. Okay, that's your debt to income ratios. And the ratios that conventional use, you could only be between 43 and 45%. Okay, so 43 to 45% of the money that you make can go to your housing payment.
Excellent explanation.
Okay,
Yes.
your housing payment, your credit card payment, your credit card and car payment.
Okay.
All of your debt.
All of your debt. Right.
Your student loans,
Right.
it goes to all of your debt. So therefore, only 43 to 45% of your income can go towards finding a home. So when we say like that, a lot of people, if their income is a little tight because they have credit card bills, they have one or two cars, maybe two cars in the family, or maybe 3 car notes in the family, some student loan debt, to use a 43 to 45% debt to income ratio, it might not allow you to afford so much home. So we just have to be careful of that. But if you have the income and you paid off your debt and you've done everything you needed to do before buying a home, and I'm not saying that's what you have to do, but if you have done that, we can look at the conventional loan product. Okay? And the reason, how can we say this, Jackie? A lot of sellers today, they like their buyers to be in the conventional program. Right? I guess because the debt to income ratios are so tight, they get the impression that, well, if the debt to income ratios are so tight and you can afford my home, that means you have enough money to buy my home.
That's one aspect.
One aspect. What's another one?
The other aspect has something to do with the way that the home is appraised. Because they will not have as many lender required repairs with a conventional loan.
Or government repairs, right? We'll talk about that with the other loans. Right. Exactly right, Jackie. Yeah, thank you for bringing that up, because you're absolutely right. Because conventional, they're more stringent when it comes to your debt to income ratios, but they're more loose when it comes to your appraisal. So what that may mean, they may not look at a shaken railing.
Well, actually, they will, because
the conventional will?
Yeah, because that's a safety factor. That's a safety factor.
Okay, because it's a safety.
Yeah, so any safety factors they will.
Okay.
But there are lots of things that they just won't look at.
They just won't look at.
No.
That some of the other loan products will look at. So a lot of times, sellers feel like we could get away with some things, and that's not always negative, right? It could be things that are very minimal, and if you really want the house, those are things that maintaining the house or maintenance that you could do yourself. But they also feel that you are more qualified because the conventional loans are a little bit more stringent.
Gotcha.
Right? And a lot of times, sometimes the realtors will put in for the sellers only conventional
Yes, financing.
Only
exactly.
only
That's right,
conventional
that's right.
financing.
And that happens a lot, of course, when it's a condo, especially.
Okay.
They will say it's not FHA approved.
Right.
So they would want it to have a conventional loan.
They would want it to have a conventional loan. So that's one thing you have to look at when you're looking at conventional. Now, with some other things, conventional has their own grant that the lenders can give you. Now, the grant would be under the lender's name. Like we have the Cardinal Financial Grant, but it's really the Freddie Mac Smart Borrow Grant, and it's up to $1,500. Some of it, depending on which grant, can go up to $2,500 to help you with down payment or with closing costs. Now, in order to qualify for that, you have to be in a certain income. So they want low to moderate income borrowers can apply for that grant. So if you're getting conventional, no other down payment assistance programs, ask your lender, do you participate in the Freddie Mac Borrow Smart? If I'm going conventional, I want to know if I can get that $1,500 to $2,500 just to help me out if you're not doing any other down payment assistance programs. Because if you are doing some other down payment assistance programs, the lender may or may not allow you, just depends, may or may not allow you to get that extra assistance. So with conventional, they have their own product to help you with down payment assistance. So just make sure that you ask, and then make sure you fit into the income bracket, because it's going to be low. It's going to be low. Oh, I'm sorry. Somebody's calling me on my computer. I am so sorry about that. Okay, so let's move on. Sometimes things like that happen, right?
That's right. It happens. I know that.
Somebody's looking for me right now, but that's okay. And they're probably going to call back again. So excuse me for that. We're going to make a blooper tape, right?
Yo, we
Can we make a
definitely need to
blooper
do
tape?
that. Oh my
We're gonna make a
gosh.
we're going to ask the owner of V&P if mortgage financing and home body ready can do a blooper tape, because you guys should see some of the things that happen behind the scenes here. So, okay. So we got a phone call. That's okay.
That's a first.
So anyway, I'm moving right along. So with conventional, those are some of the things that you want to look at. Now, it says that Fannie Mae will go down to a 580 credit score. Let me just warn everybody with that. I have not gotten that yet with a 580 credit score, but doesn't mean that it cannot happen. Okay? It just depends on, let's just say you just paid off all your debt and you try to raise your income and try to raise your credit score, and you really want to buy this house now and you have a 580 credit score and you need to go conventional. So what will happen is when the lender does the automatic approval, it goes out and Fannie and Freddie look at that and they decide, okay, well, they paid off all their debt. We see that they have a good income, and then you may just get approved in automatic underwriting system. I don't know if you guys remember, Jackie and I talked about that several shows ago, about getting an automated approval.
Yes.
Because it's an approval versus pre-qualification.
Yes.
So if you get an approval, that's an automated approval. That means the underwriting system has looked at it, and the only thing you have to do is produce the facts. So if you get that automatic approval with a 580 with a conventional loan, then you're good to go. You're good to go. But because they're a little bit more stringent, sometimes that just may not work out. So then you would have to go to another loan product. And then the next loan product normally is going to be FHA, the Federal Housing Authority. Everybody knows about FHA because they call it the first time home buyer program, but that's not what it is. FHA is not a first time home buyer program. It can be for first time home buyers, but FHA is a government backed mortgage product. And the reason why people call it a first time home buyer program is because it is backed by the government. The credit doesn't have to be a credit A1 credit like conventional may have to be, depending on what your scenario is. You could get better interest rates going FHA because it is government backed, because that means that if you ever default on the loan, the government is going to pay the mortgage company for your loan. So the things that FHA look at, they want to see that, okay, you're trying to get your credit back on track. You have the income. You may have a couple blemishes on there because, believe it or not, if you have a charge off, FHA lets that go. If you have collections, as long as the total of your collections, and this means the total, whether it's husband and wife or just either one of a husband or just a male or female purchasing the home, if your collections are less than $2,000, FHA they don't worry about that.
Okay.
Okay. If it's over $2,000, individually or collectively, jointly, then what will end up happening is you can get yourself on a payment plan. And as long as FHA sees the guidelines of the payment plan and you've made 3 consecutive payments already, and then you send proof that you're making payments, then FHA will accept that. And that also goes for taxes. If you have back taxes and you couldn't pay all your taxes, and if you make a payment plan with the government for your taxes, you can send that payment plan in, and the payment plan the monthly payment that you pay each month will be added towards your debt to income ratio. So those are some things that FHA, that the government-backed loan, will do for you to help you qualify for the home. Also, FHA gives you 3.5% that you have to pay down, where conventional is only 3%. So FHA asks you for a quarter of a point more for down payment. Okay. But we'll talk about down payment assistance, and we'll see how you can kind of clear that up if you're using down payment assistance. But you have to put down 3.5% for FHA loan, and conventional you have to put down 3%. That is the minimum. You can put down as much as you want, but the minimum for FHA is 3.5%, and the minimum for conventional is 3%. Another caveat to those two, and the reason why I'm just staying on those two a little bit right now, because that's the loan type that most people fit into, is either conventional or FHA, right?
I wanted to ask a question, but I'll wait till you do your caveat.
So I do my caveat?
Yeah, do your caveat.
Now I forgot what my caveat.
Uh-oh. Okay.
I forgot what my...
Okay.
I asked you a question.
Okay, so if a borrower goes to a lender and the lender comes back to say that we have an FHA loan for you, but everything that you just said, that borrower would actually qualify for conventional, should the borrower ask the lender to look at both for them?
I think that they should ask the lender to look at both of them, right, depending on the credit scores. And the reason being, because there is a fee that's added on to the loan. So the government fee, they will add 1.75% onto your loan that you have to pay FHA, that you have to pay the government to get that loan, whereas conventional doesn't add that. And that fee actually brings your loan amount a little bit higher. And then your mortgage insurance, if you're not putting 20% down on either one of them, you're going to have mortgage insurance. FHA mortgage insurance is higher than conventional. So a lot of times, even though you may get qualified, just say for a $400,000 home, if you go conventional and everything is good, you may qualify for $430,000. Whereas for FHA, you would only qualify for the $400,000. And that is because in the monthly payment, the mortgage insurance will be a little bit less, and then the loan amount would be a little bit less because you're not paying that 1.75% fee for FHA.
Conventional. Right. Okay. So I just learned something, that I was the person that I was talking about.
Oh, okay.
And I was not given a choice.
Okay.
And now, 7 years later, I want to go back and say, you should have given me.
You should have given you that choice.
You should have given me conventional.
Exactly. Well, they think that it's easier to go conventional, right? People think, loan officers and realtors, people in the industry, you want to get the house, you want to get it closed, you want to close in 2 to 3 weeks or 4 weeks, you want to get it closed. Well, new construction, that's not going to happen with new construction.
Nothing that you just said, a reason why someone could qualify for conventional. I had all of those, and I was not given a choice. And later, now that I know more,
now that you know,
it's like,
and you didn't ask, they just automatically. It wasn't your first home, was it?
No, it wasn't.
It wasn't your first home.
No.
So,
as a matter of fact, it was my third.
Okay.
And I still owned all 3 at the time. That's crazy.
So you went FHA or you went conventional? They took you FHA.
FHA.
Okay, and it was going to be your primary.
Yes.
It was going to be your primary,
Yes.
and the other 2 were conventional then. Because FHA will only allow you to have one home, period, your primary home at FHA.
Well, see, the first one, I have no idea. I don't even remember.
Yeah. So therefore,
anyway.
if one of your homes was FHA already, FHA would not have allowed you to get another loan, FHA.
Okay,
So the other 2 had to be conventional.
Okay. I'm going to look that up.
Yep. It has to be
you,
conventional.
Barbara.
FHA don't do investments.
Right.
FHA don't do 2 homes.
yeah.
FHA you have to have a primary home.
Okay. All right. Well.
Okay.
Thank you.
And that's the reason, because the government's not going to back up all these homes that you,
right.
you know, the person may want to buy. You know,
Right.
just think
Well,
about
I know
it.
not
Right?
not investment, but
Right.
maybe they had a reason, but I was never given that information.
The option.
The
Right.
option.
The
Exactly.
option.
That's right.
Absolutely. So yeah, you want to, you know, especially if you are really a first-time home buyer, you really want to make sure is conventional the way for you to go, or is FHA the way for you to go. And the main way that you could probably tell yourself which way you want to go is what your credit looks like, what your credit scores are,
That's right.
and what your income is. That's one of the main basis way that you don't even have to ask anybody. Okay, you know you make a good income. You know your debt is not high because you've paid all your debt. Check. And you've looked at your credit scores. You've checked your credit scores before coming to a loan officer and having them check your credit scores. So if you check those 3 boxes, then more than likely you can go conventional. And so then when you sit down and you meet with a loan officer, you can tell them, I want to look at all my options. I want to look at government loan, and I want to look at a conventional loan. And I want to compare what the mortgage is going to be, what the differences are going to be, to see which one that I want to get. Okay? And that's basically, I mean, that's your right. You don't have to have somebody just put you in a loan. Right. But what does happen, Jackie and I, because Jackie does a thorough job in talking to her client. So when Jackie's sending out a referral, I mean, it's like a 3-4 paragraph on the client. I mean, I've learned that I know they got 2 kids. I know whether they first time home buyer, whether they sold their home, they getting another home. I know what their job is, what their income is. Their credit is mediocre. I mean, Jackie, you know, I have all the information when Jackie gives me a loan, and then she also says, you hit the apply now button, because Barbara's not calling you until you hit the apply now. You know, so Jackie gives me a whole lot of information. So when I actually start talking with you, only thing I do is I have to fill in what she didn't get. But more than likely, I have all the information I need.
I try.
Yeah,
more than likely.
I mean, it's excellent. I love it.
I think the last one I was a little...
It doesn't matter. I don't get no less than 2 paragraphs. Let me just say, no less than 2 paragraphs. And it's okay. I love it, right? Because I know all about them. And then I also know they're not going to call me until they've hit the apply now button. Now, unless they just can't do the computer,
That's right.
Jackie will let me know that too.
That's right.
And that means Barbara, get on the phone and call them.
That's right. And I say that to them.
Yep.
I say, if you're not comfortable with the electronics, computer, whatever, Barbara, she's a hands-on lender. And that's one of the things that I really love about Barbara.
Thank you, Jackie.
She is not just going to make it all automated. And some of our clients, they don't like to do automated
They just
things.
don't like to do
Yeah,
it.
they don't like that. So I really let them know, you don't have to worry.
Thank you, Jackie.
You're
I appreciate it. She's good. Thank you. I love that. So I have all the information, and then when I initially talk to you, I can tell whether or not, just by having a conversation with you, even before I pulled your credit, whether or not you'll be a FHA borrower or a conventional borrower. But that, I only know that until we talk about the other programs too, because I'll be able to get a better understanding of where we're going to put you. So we've talked about conventional, we talked about FHA, we have a few more to talk about, but we are going to take a pause and we're going to pay some bills around here. So we'll see you when we come back.
It is key that you mind your mental health.
Hey guys, how's everyone doing this week?
Hi.
Use the 5 keys to mental movement.
This week has been a really monumental week for me. I realized that I was not being myself.
Reaching out.
Be positive attitude person self, like you guys know me to be. I was
Staying
listening to
upbeat.
teaching and get back to that happy, cheery self of me.
This week's been kind of
Being
stressful,
creative.
all of the workload that we have on online learning. So I've been trying to use different platforms and different websites to help ease my mind and ease my stress.
And what about you, Margaret?
Well, you guys know me. I just love to work with others and serve them.
Serving others.
Realize that when I serve others, my mind is off of myself.
That's right. And don't forget, self-care is key.
Self-care.
All right. So see you guys next week.
Right.
Bye.
Your mind matters.
Okay, and we're back with Mortgage Financing and Home Buyer Ready. And as you know, I'm Jackie Abrams, and we have
Barbara Grant Proctor.
yes, and Barbara was just giving some fantastic information on different loan products. And so far, she's covered FHA loan and conventional. And I said it backwards. She covered conventional first and then FHA.
FHA loans.
So I don't think we quite finished FHA.
No, there was a couple other things that I wanted to talk about with FHA, and that was credit score requirements. Credit scores for FHA can go down to 500.
Whoa.
Now, to get an automatic approval, you have to look like you've been cleaning up some things, and maybe you're on payment plans and your credit scores just haven't started to go up yet, but you want to buy a house. So FHA can go down to 500. Now, because it's down that low at 500, they want you to make a bigger investment. So if your scores are below 580, between 500 579, you would have to put 10% down on the home. 10% down. Once you get to 580, then you could go back to the 3.5% down. So that's pretty good, because sometimes, like I always say, sometimes bad things happen to good people,
Yes.
right? And so you may have just recovered from being laid off from a job, and then you're back into into your job situation, and you're making good money, and you're trying to pull yourself through, and you've started saving, and you have your savings, and your scores just aren't quite at 580, but you're ready to buy that house. And so you say, well, you know what? I want to get into the house, continue to build my credit up, and then possibly do a refinance. So some people do that. So the scores may not be at 580, but they have the funds to put the 10% down. So they go ahead and they put the 10% down. It'll be a higher interest rate, of course, going into the house. But the good thing is they're at 90% loan to value. So by the time they refinance, they may be at 80% loan to value. I mean, you just don't know. You don't know what the market's going to do. You just don't know. So sometimes things like that do happen, and your scores are under 580.
Let me say something on that, Barbara. One time I went to some type of a session, and they had a loan officer there, and there were lots of buyers in this particular group. Lots of, I guess they were all buyers, and it was a sponsored event.
Yes.
And we met at an eatery for breakfast, and so there had to be at least, I don't know, maybe 40, 50 people in this room. So when the loan officer said that you could have a credit score of below 580 and you could still get a home, he never said that you'd have to put down 10%.
Right.
So it was kind of new in my career, and so kind of early, I guess I should say, in my career. So I knew there was something that didn't quite sound right. And it wasn't that it wasn't right. He just didn't disclose everything.
right.
So I'm sitting at the table with many first-time home buyers, and I say to them, don't get so excited. And actually, one of them was a client that we ended up selling to a few years later. And so I said, don't get too excited. I said, this doesn't quite sound exactly right. I think there's something else that kind of goes along with this. So when they had question and answer, about 30 minutes later, I decided to go up and ask him that question. And of course, he said it, but he kind of whispered
it. Didn't want people to know.
Right. So I came back to the table, and I was telling my table and the table that was next to me and the table that was behind, because everybody started kind of cheering when he said you could have that low score. Well, of course, if he had said 500 score but 10% down, he may not have gotten as many cheers.
Absolutely, because it just all depends. It's a certain buyer.
Yes,
right?
that's right.
It is a certain buyer.
That's right.
And that's something that everybody needs to know, that it is the 10%, because it's advertised. People hear about it going down to 500, a credit score, and you're like, what? You can really buy a house,
That's
with
right.
500 credit
That's
score?
right.
But you got to have the money. So if your house is $400,000, and we're talking about just down payment alone, not even closing costs, $40,000 is going for the down payment.
Yes. Hello.
So you have to have. Now, some people buy a house and they put 10, 15, 20% down.
Some people. Yes.
Most people don't. Most people keep the money. But, if that's your investment and that's what you're looking at it as being your investment, and you want to put, 15, 20, 30% down on your house.
30%, Barbara.
Some people. Yeah.
30?
Yeah.
Okay.
Okay. Let's say, for instance, you sell a house and you're buying another house.
Yes. Okay. I got you. that makes sense.
And nowadays, a lot of people, their 401ks, their pensions, they have the money.
Mm-hmm.
They can put it down. Think about all the people. It's a seller's market, Jackie, and people are bidding over the value of the home,
Yes.
and they're paying cash at the table.
Yes, you're right. You're absolutely right.
Between savings, 401k, mutual funds, IRAs, they are cashing
literally
them in.
breaking the bank to
They're
come
cashing
in
them
with
in.
all of that money.
Didn't we just hear somebody winning a bid?
Yes,
What, we gonna put
yes,
50 or
and
$60,000?
and it was not my client, okay?
Yeah, it was my client. And they were coming to the table with 50, 60, not the mortgage, just 50, $60,000 over the appraised value and asking price of the home.
That's right.
Because that's how bad they wanted the home.
And they got it.
That's a lot of money. They're walking into the home with negative
yes.
equity.
Equity. Hello.
Negative,
Hello.
but some people just don't care. That's just what they want. And it'll take, a few years for them to recoup that.
More than a few, but
Yeah, 65,000, depending on what the market is doing. If housing goes up, but if it does, that's $65,000. So they're coming from their savings, 401k. So it just depends on, people sometimes they look at what their monthly payment's going to be, because I've had several clients, especially senior citizens, they're retired now, they have their pension, they have their Social Security, they have their savings, and they want to buy something, and they say, okay, I'm coming to the table with $100,000 because I need my payment to be X, Y, and Z. Or they say, I don't want my payment, whatever they're buying, over, let's say, $1,500 a month. How much would I need to put down to make sure that my monthly payment? So, people are doing that.
yes, I agree. I agree.
They saved their whole lives, and they're going to use this sort of investment to live out the rest of their life, and they're going to buy that home and put that money, so their payment is not huge. So, if you're a 500 score, again, like I said, sometimes bad things happen to good people, but you got that money locked away somewhere, or, you've built your 401k up, or you managed to hide your pension and your and your mutual fund and your IRA from the government. And so now you want to bring it forward and buy a home,
Whatever
right?
it takes,
Or under the
right?
pillow.
Oh, under
We
the,
have some
oh
under the
my
pillow
gosh. Under
clients,
the mattress.
Under the mattress.
Oh
We have some
my
under.
gosh.
Where did that money come from? Well, it was under my mattress. So we have some under the mattress clients that buy homes. Nothing wrong with it.
Until you don't follow instructions.
Well,
but that's a different story.
Well,
I'm not going to go back there.
Yeah, we have to see where the money's coming from, but we worry about that when we get to that point, right? But we do have some clients that have money under the mattress, so you just never know. The 10% might not really mean that much to some people. It just depends on the borrower. So another thing that I love about FHA,
Okay, what is
the
that?
debt to income ratios.
All right.
Normally, the highest you can go is 50% debt to income ratio. That's the highest. Conventionally, it says you can go to 50, but you're not getting approved at 50%, okay? FHA says you can go to 50. You can get approved at 50, over 580 credit scores. That's very good. But guess what? If you get a home, and once you add the taxes and insurance and the mortgage insurance, and let's say your debt to income ratios come out to 52, 53%. If your credit, is looking good, I'm not talking about A1 credit. I said over 580. But you paid down, you don't have collections, you don't have, your credit's looking, you're bringing it back to where it needed to be. Maybe you had a bankruptcy 3 years prior to that, right? And your credit is starting to build, but your bankruptcy's 3 years behind you, so you can get a home. Okay, and you go and you look at a home and you go, oh my goodness, I don't know if I'm gonna be able to afford that home. But then I put the information in, and once I have all the correct information, the taxes, and it's like 52, 53%, I do an automatic approval, and FHA say, sure, you can buy this home.
Wow.
I actually have a client now. They're at 58%.
Whoa. And FHA
58%.
gave you an automatic.
I have an automatic
Wow.
approval.
All right,
yes. That's what I love about FHA. They go out, they look at your credit, they look at stuff, and they say, okay, we can give this borrower a break, and the debt to income ratio is higher than 50%.
Okay.
So there's a lot of things, a lot of caveats that you can look at. So if you understand, you can talk to your loan officer, and sometimes you got to pull the stuff out of them.
I was just about to say, talking
Yeah.
is one thing, but having the background knowledge that Barbara's giving
Yeah.
makes a whole another difference. It really
Yes.
does. It really
so
does.
you can ask these questions that I'm telling you, and if they can't answer them or don't want to answer them, find yourself another loan officer.
Hello. Maybe,
Find yourself a loan
maybe,
officer.
maybe it might be someone named Barbara Grant Proctor.
It just may be.
At Cardinal
Send
Financial.
me an email. Call Jackie. Call Barbara. You can do that. It just may be. Find yourself. I really suggest you find your if your loan officer is not working for you in the finance part and helping you understand and getting you the best rate, getting you your DTIs, getting you the best loan program, then yes, look for another loan officer. So now with that said, I'm going to move on to I'm going to save the best one for last.
Okay.
Okay.
The
You know
best.
which one. You know which one I'm
I
talking
do.
about, right?
I do.
Okay. So right now we're going to talk about veterans. So all the veterans out there, the VA loan. All the veterans, I know you are aware that VA loans, that's your 100% financing. So veterans can get 100% financing. It's also another government-backed loan. A certain portion of the loan, like 144,000, I think it is backed by the government, by the VA administration. The interest rates for the VA loan are usually probably the best rates on the market.
Okay.
They're normally probably the best rates on the market. But FHA and then the next loan product we'll talk about, they're very, very, very close. But VA loans are normally pretty good. The other thing with VA loans, there is a strict debt to income ratio that you do have to stay on. That you can't go above the debt to income ratio, your front end and back end. And what I mean by your front end, your back end. So if you ever hear a loan officer say, okay, your debt to income ratio, your front end is 35%, your back end is 45%. What that means is the 35% is how much home you can afford to the value in your income. So 35% of your income can go towards your home. So if it's 35, 37, 41%, depending on the loan product, that percentage of your income can go towards your home. The back end ratio means all your debt combined. All your debt combined. So if they say your ratio needs to be 50%, your front end ratio needs to be no more than 35%. What that means is you only have 15% more of your income can go to your car note, your student loans, your credit cards, etc.
Good point.
Okay, so that is a front end and a back end ratio. So you have to fit within, well, what I say, take that round peg and stick it in that square hole. You're going to have to take that round peg, stick it in a square hole, and hope you can squeeze it, hope it stretches a little bit, and you can fit that round peg in there to try to fit in with that program. Now, the good thing about a lot of these programs, they have compensating factors, okay? We may be able to go a little bit higher on your debt to income ratios if you have this, if you've done this, if you can prove this. So I'm not going to go through all of those steps, but if you know that, your compensating factors, if your loan officer asks you, like you saved money, or your credit score is better than the minimum credit score that is needed for that loan product, those are called compensating factors. So, for instance, 580 for FHA, and you have a 680. That's a compensating factor. One of the compensating factors for VA, and I'm not sure if all lenders are doing this, because lenders have what's called an overlay. What that means is VA, FHA, conventional, they have these debt to income ratios and they have credit score limitations. Your lender can now add on top of that. So say, for instance, my company, we go down to 500, 10%, that's what FHA says. 580 is 3.5%. That's what FHA says. But you may go to a lender and they say you can't have below a 600 credit score to get FHA. That is because they're adding what's called an overlay. An overlay.
So they're taking what the government standards are.
They're taking what the standard is,
And
and
they
they're
are
adding
adding
their risk
their-
protection.
yes.
Their risk protection. Because they don't want a lot of loans that they think may default. They don't want a lot of loans that are just right there at what the guidelines are. They want to make sure that their borrower is not a risk to their company. So they may add an overlay. That's why people call around and check interest rates and what does your credit score go down? And then they're wondering, how come everybody's not the same? Well, everybody's not the same because each lender is different. Some lenders will say, we don't add any overlays. We have no overlays. So if you hear that the credit score is 580, that's what the credit score is, 580. If you hear your debt to income ratio is 50%, that's what we're going to go to, is we're going to go to 50%. We're able to do that.
If they have overlays, they're not advertising that.
No.
You'll never hear that.
No, you're never going to hear the overlay. You're never going to hear the overlay.
So
because
that's a
not
word
what
to remember, to ask.
Yeah, remember to ask. But if you familiarize yourself with, what a credit score looks like for conventional, what does credit score look like for FHA, and this is my big announcement, Cardinal Financial, VA loans, we now go down to 550. Boom.
Wow.
550
Wow.
credit score.
Wow.
100% financing.
When did that start?
About 2 weeks ago.
All right now.
You heard it here first.
Cardinal Financial.
You heard it here first. 550 credit score, 100% financing. But you have to have served your country first.
Yes. Yes.
So if you want to run
and
out,
they deserve that.
if you want to run out and
Definitely.
serve your country real quick and come back, no, I'm only kidding. But VA goes down to 5 with us, and I'm sure some other lenders are doing it too, because VA is allowing it.
Okay.
But a lot of lenders are not going to, publish that, and they're probably not going to do that, because VA is another one of them loans that you gotta fit that round peg into that square hole,
Got
right?
you.
So we go down to 550, 100% financing for VA. Interest rates for VA are normally, like I said, better than a lot of the other loans. So, that's a good thing, because we want to do that for our veterans. We want to do that for our veterans. So VA, if you are a veteran and you haven't used your loan, you just refinance or purchasing, one of the best things to do is go ahead and use your VA loan. Okay? Now the next one, this is the one, me and Jackie, we just love this one. When I introduced this to Jackie, she was like a child with candy. Oh my goodness, she could not believe this loan.
She is telling the truth.
She could not believe this loan. And then when we started doing the loans, we were like, shh, don't tell nobody. Don't tell nobody. This be our secret. This be our secret. Because a lot of people don't do these loans. And we're going to tell you why a lot of people, don't do these loans.
Well, that was definitely back then. It's
coming out a little bit, but
It's coming
but
out
the
a lot
areas
now.
people are
Right.
not
That's
really.
right. That's right.
They're not really doing it. They're not really doing. I don't hear a lot of people say that they got this loan. Well, anyway, it's called a USDA loan. Now, when you think of USDA, what do you think of?
Agriculture.
Agriculture.
In the cornfields.
In the cornfields. I think of USDA on all beef products, right?
Yeah,
Stamp
that's
USDA.
Right. That's right. That's
the
right.
agriculture loans. Normally they were for farmers,
That's right.
right? But they're for residential housing. Residential. Now, this loan here is 100% financing. Love it, love it, love it. And it is for low to moderate income borrowers. So you can't come with $200,000 a year and say, I want to get this agricultural loan. It's not going to happen unless you have about 10 kids. So, excuse me, children.
Well,
Children that are on your taxes. I want to make that clear.
right. You're not talking about goats, kids.
No, yeah, kids.
Yeah, right.
We're not talking about
right.
Billies.
Right.
We're talking about
Kids.
children
Right.
that are on your taxes for the last 2 years. So they look at how many children you have, how many that are in school, what you're paying children, that's in kindergarten, you're paying before and after care. They look at your income. They look at all of that to see if you can fit into their program. And if you do fit into their program, they have excellent rates too, 100% financing. But this is what I love. If you go out to get an appraisal for the home, let's just say the appraisal is $500,000, but your contract is $480,000. That $20,000 difference, USDA will allow you to include that in your loan and pay your closing costs.
Whoa.
Isn't that amazing? That is just amazing. And another thing that I love about USDA loan, if you have money between the appraisal and the contract price, and there's some things in your house you want to fix up before you close the loan, they'll let you do that too.
I love it.
They will let you do that too. So USDA is such a great loan if you have someone that knows how to utilize that loan for you. We've had people come to the table. How much money? How much money, Jackie? How much money? USDA.
They'll come. I'm sorry. They'll come to the table.
How much money would they have to come to the table with?
Oh, very little.
Very little. Very little to nothing.
Very little. Very little.
USDA loans. You may be able to come to the table with zero down, no closing cost. So when we come back, I'm going to tell you a little bit more about USDA. So just stay tuned. We'll be right back.
My name is Emmerich Peace. I am a husband, a father, an entrepreneur, a businessman, a real estate sales consultant, a lover of life, and a giver of the community. What family means to me, it means togetherness, love, happiness, support, inspiration, providing, ensuring, securing, loving. Family is what I live for. The things that I do in my day-to-day life is to support my family first. And then I go and live my family because I work my hardest, I do my best, just not to bring work home. When I'm home, I'm home. And when I'm working, I'm working. And now since I don't have any kids at home, I'm koi ponding and I'm really having lots of fun because it's just my place of just happiness, my happy place, being home, no kids at home, just being able to enjoy my home with my wife. The first time I experienced entrepreneurship,
Okay, so we were just getting lots of great information about the VA loan. Barbara was really giving some great pointers on that, and we're going to pick back up with the VA loan. What else do we have to share, Barbara?
That was the VA, but we left off on the
I'm
USDA,
sorry.
our favorite loan.
USDA, goodness
USDA
gracious.
loan.
USDA.
We left off on the USDA loan. I get so excited when I talk about this loan because I mean, there's some pros and there's definitely a lot of pros, but there's also some cons with the USDA loan. Now, USDA, they have their own system. It's called the Guaranteed Underwriting System. It's called GUS.
I was about to say, is that Gus?
That's Mr. Gus. Mr. Gus. So the only way you can get approved for USDA loan is by using their system for automatic approval. And their ratios are a lot tighter than all the other loan products. So your back end can only be as high as 41%. And with them, it's normally no ifs, ands, or buts. They may go up to 43%. Again, like I told you, with those compensated factors, like maybe you got a credit score 680 and above. Maybe you have money in the bank, even though you don't have to use the money that's in the bank. But people want you to keep your money as well. So another thing that is very, very good about USDA, they also go down to 580, Jackie.
All right now.
They go down to 580. So you can get a USDA loan at 580. Now, the front end, remember we talked about the front end, we talked about the back end. So your front end debt to income ratio can only be 29%. So that's how much house to your income that you can afford.
That
Okay,
is
so,
tight.
and that's tight.
That's very tight.
It's just tight.
But we've had clients who have been able to meet
definitely.
that.
Definitely. Especially, and again, we're going to use the term the first-time home buyers. Maybe they're buying a townhouse. Maybe they're buying a condo, right? And they're not buying. We know in this area, houses maybe $500,000, $600,000, $700,000. A lot of first-time home buyers, they may not even be starting that high, so they will fit into this program easily. For their first home. It just depends. It just depends on your family structure, what your income is, how many children you have, because they look at all of that, and that's how they come up with their ratios and whether or not you can fit into their USD program. Right. So one of the good things about USDA, like I said, you could virtually come to the table with no money out your pocket. And now I'm going to hit it with something else.
I was about to say.
I'm going to hit it with something else.
Okay,
Jackie, I just love this.
Okay.
All the things I just told you about USDA. Oh, I didn't even get to this yet. But I'm going to tell you this anyway. We're going to get to this. one of the down payment assistance programs, the Maryland Mortgage Program. We're going to talk in depth about it, but they give you money to help you towards closing or towards your down payment. MMP will allow you to tie the USDA loan into the down payment. Now, you're already getting 100% financing. You already can use the money between the appraised amount and your actual contract amount. You can already use that to pay off your closing costs or to pay things to fix your house up with. But let's just say the appraisal came out of $500,000 and your contract was $500,000. So you would get 100% financing for $500,000. So you still need some help with down payment assistance. At that point, that's when we would use the MMP program and get your closing costs paid for. Because down payment assistance is not just for down payment. It's for closing costs or down payment, whichever side that you need it for. So if we were to add those two together, you virtually come to the table with nothing out of your pocket. We've seen it. We've done it. Now, here's the con about USDA.
I was about to say, okay, she gave you all of the good things. It's still okay. It has to work for you and your family.
Yes.
But
it has to work for you and your family. In the DMV, DC, Maryland, Virginia. I get a lot of people asking, what is DMV? Is that the motor vehicles? People that don't live in there.
Right.
But in the DMV, DC, Maryland, and Virginia, there are certain areas that are USDA. Now, you would normally think USDA, like we said, was agriculture.
Right.
You would think farm, we're talking about farmland. We're talking about being out there in nowhere. No. Okay, so some of the areas, there's not a lot of USDA areas.
that are left.
Yes. Right. One of the areas, Charles County, Maryland, but you're further out, not Waldorf. Those of you that are watching and you know the areas in the DMV area and you know Maryland, Charles County, there's certain areas that will have USDA. Prince George's County, unfortunately, has two areas, just two. And one of them is actually out where I live. Don't come looking for me, though. But it's out there where I live in Akakeek. That's a USDA area. And that's right before the Charles County line. And then the other area is in Marlton off of 301 in Upper Marlboro. Yes. So, and when you know that area, you don't think of country, you don't think of farmland, right. you don't, I mean, there may be some deer running around every now and then, but right, Jake, am I right?
Yes,
but that's about it. And that's a well built up community with townhouses and single family homes in that, just that development on 301 in Upper Marlboro is USDA. So someone looking for a house and they say, I don't want to move way out in Charles County. I don't want to move to Akakeek. I want to stay in Upper Marlboro. When we tell them about this loan, they start looking in that area immediately.
That's right. It works.
It works.
It really does.
It works. Now, in Charles County, you go a little further out. They used to have White Plains, but they don't have that anymore. You got to go to like La Plata and then a little further out. Indian Head.
Well, this is really everything except what you said.
Waldorf, White
Waldorf,
Plains.
yes.
Waldorf, White Plains.
Yes.
But White Plains used to have a certain section, but they've cut that off. So I think that they're starting to branch out a little bit more and cut off some of the USDA areas. Now, you can go further out Montgomery County. You can go further out Calvert County.
And when she says further out, she means way out.
Further out.
So it's not going to be your Columbia in Montgomery County.
Right.
It's not going to be your, I guess that's actually Howard County. Sorry about that.
Howard County.
Yeah.
The other counties, you got to go a little further
out
to get USDA.
Way out.
Yes. So, and like Alexandria, Arlington, that's not going to be USDA.
No, it's not. Well, that's Virginia.
That's Virginia, but it's not going to be USDA, right? Because those counties are well populated and built up. But it does not mean that you cannot find an area or a home and use the USDA loan.
That's right. We actually had someone to go way out to Carroll County.
Of course.
Westminster.
Yes.
From where I live in Upper Marlboro, it was an hour and 45 minutes without traffic. But it worked. It worked for them. It worked for me. We went out there one time. We found the home. And 2.5 years later, they've been out there loving it.
Yep.
So, and they were able to get the USDA loan for that.
It's a USDA loan. And then you would also think that maybe Brandywine would be you. Now, that's country.
It's not. It's not on the list.
That to me, that's
It's
country.
not on the list.
And that's not on the list. So, if you're looking for 100 and clients always say, is this the 100 financing out there? And I always say, well, yes, it is, but these are the areas. And a lot of times it's, oh, no, I want to be, closer into the city. Well, you're not going to
I
find
want to be in
USDA.
Landover.
Yeah.
Okay, that's fine.
That's
you can
fine,
be in Landover, but you're not going to get USDA.
So let's look at some other down payment assistance programs and let's see what we can fit you in. But I just wanted to make sure that, people understood with that loan being 100% financing, VA being 100% financing, only if you're a veteran. And then you have your FHA, 3.5% down. Then you have your conventional at 3% down. There's definitely a program for everyone, because the lowest, all these programs combined, I'm not saying individually, I'm saying combined, just giving an overview. You can go down to 500, as long as you got some cash, you got 401k, you got some money saved up to put the 10% down, you can go down to 500. But then if you go to 580, then you're only going to be between 0 and 3.5%. You like that? 0 and 3.5%. I like that. That's how much you're going to have to pay for down payment. Now, before we actually move on to down payment assistance programs, let's talk about closing costs real quick.
All right.
Okay. So we say 0 to 3.5%. That's just the down payment. There are closing costs to your loan. That normally runs between 4.5%, maybe. And I say that only because it depends on what area you pick and what your taxes are. So these days, you got to have that, because the sellers, but this being a seller's market.
That's right. Good
The
point,
sellers,
Barbara.
the sellers are not paying your closing costs. I don't know if some of you remember the time when sellers gave the 3%
Let's
or
try.
3.5.
Let's say maybe 2 to 2.5 years ago.
They were helping you.
Yeah, they were giving 3%, and that was pretty standard.
Yeah, that was pretty standard.
2 to 3.
Giving you money to help
Pretty
you
standard.
to close the deal. That's not happening anymore.
Not on a wide basis, not at all.
Yep. So therefore, if you're not in one of those 0% loans, you have to at least make sure that you have about 4 to 4.5% of the amount of home that you would like to buy, that you think that you can qualify for. You have to have those funds somewhere available so that you could pay the down payment. Because, and when I say sellers aren't helping, they're not helping with anything. They're not helping with anything. You're paying every single penny. But before, sometimes they paid for the appraisal. Sometimes they paid 3%. They're not doing that anymore. So you just have to make sure that
they made repairs.
They were making repair. They're not making repairs. Right. People are buying homes as is.
Yes, that's right.
As is.
That's right.
Now, the good thing about it, even though it's as is, and I don't go backwards. Remember we had Steve here?
Yes.
Jackie will still make sure that you get an inspection. She will tell you have to do the inspection. You have to know what you're getting into, even though the inspection doesn't count because you chose to go for an as-is contract. So Steve will go out, he'll look at the house, and he'll be able to tell you what's going on with that house, and then you can make a decision if you want to go forward with that contract, right?
That's right. That's how he does it, and that works.
That's how he does it. That's how it works.
Although lately, people have been doing, not even making that a contingency. They will do something called a pre-offer inspection and not even have that built into their contract.
Absolutely.
Things
and then
have
you may not even win the contract because you're doing that, right?
Right.
So our time is running out again today. I mean, so much. Next time, we are going to talk about the down payment assistance. I know everybody's trying to get to that. We're going to talk about the down payment
But this was
assistance
important.
programs. This stuff was important to do the loans
It
first.
was.
So next week, when we come back, we're going to do down payment assistance programs, and then we're going to have some more guests come in. We're so excited about all of that. So we're really, really looking forward to this. Right, Jackie? You have any last remarks?
The very last remarks. Okay, so we are Mortgage Financing and Homebuyer Ready because we want you to understand something. We want you to understand your power to purchase. Yes.
See you in 2.